Welcome to Industry Focus, the show that dives into a different sector of the stock market every day. Today is Wednesday, October the 31st, and we're talking healthcare. I'm your host, Shannon Jones. I'm joined via Skype by specialist Todd Campbell. Todd, I am super excited because, first of all, today is Halloween. And second of all, we're doing a nice Halloween-themed episode focused on Halloween horror. Specifically, we're talking scary markets, scary stocks, and how to best keep your fears in check during this spooky time. Todd, as I understand it, when it comes to Halloween, the Campbell household goes all out. Am I right?
We do. Oh no, I just lost my prop. I had my wig on and everything. Our listeners won't be able to see it. They'll have to go online to Twitter or something. I posted it there. People can see my mad scientist outfit this year.
Yes, and please check out Todd's costume on Twitter. Todd, you're at EB Capital, right?
Yeah, absolutely. And, I think that people will get a kick out of it. You're going to have a little bit of fun, right?
That's right. And Todd, I think in this day and time, we really do need fun, because when it comes to scary, really nothing is scarier than the markets right now, especially over, of course, the month of October, the spookiest month of the year. I actually read one headline this morning among many that were, of course, fear-mongering, but it said basically the S&P 500 is actually set to finish October with its worst month since the 2008-2009 financial crisis. And it's not alone. Many of the other major indices are also down too. Todd, the uncertainty and the fear of the markets right now is certainly reaching new heights. Should we all be afraid?
Yeah, all that howling we heard last month wasn't werewolves, was it? It was people checking their account balances,
exactly.
Groaning in agony at watching what was happening. I think that, it's very important during these scary times, right? And I mean, to get real for a second, I'll even take off my wig so people can really see I'm getting serious. Corrections like this, they're pretty common. Yardini, which is a research firm that's been around, since I've been in the business since the late 90s at least, they keep track of this stuff. There's been 7 drops of 9% or more just since 2010. I think we got down to about 9.4% on the month at one point. So these are not that uncommon. There's been 11 drops of greater than 5% or more since 2010. And yet, as scary as those were, right, because you had stocks, individual stocks, especially if you're a growth investor, get walloped a heck of a lot more than that, right, Shannon? I mean, you had names like Bluebird Bio that fell, I think, 28% in the month. You had, the IBB, which is the Biotech ETF that I like to follow. That was down 15%. So, these are painful in the moment, but recognize that despite all of these that we've had in the past, just since 2010, the market has recovered and gone on to make new highs. And the wrong choice, or the scariest choice, the one that would leave you groaning, much longer into the future, would be to react to those moments and sell, and not to have been able to participate when those stocks rally back. Because Shannon, I guarantee, if you sell during those moments, you are not going to time the bottom perfectly. You are not going to get back in and ride that higher.
And yeah, Todd, to your point, where we are at in this particular market cycle, it's nothing new. And more importantly, there's not any one thing really driving kind of the slowdown across the stock market. You've got U.S.-China trade war concerns. We're in a rising rate environment, particularly in China, too. You've got heavy selling for a lot of Chinese stocks as their economy continues to slow down as well. And then, of course, as everyone knows, we are approaching election season. There's a lot of political rhetoric going around right now, especially as it relates to drug pricing too. So you're seeing that play out across the sector. But to your point, and going back to what you said, the key is not to be afraid, not to sell your stocks. If anything, consider this an opportunity to really double down on some of those really impressive stocks that have good management, are continuing to drive both top and bottom line growth, and really figuring out how you can buy a lot of these stocks at a discount.
I agree with that. And I've been watching the markets very closely through the internet boom and bust and through, the Great Recession and through where we are today. And that kind of a long haul strategy is what can allow you to sleep at night. And, I'm sure we'll talk later on down the show. I mean, not every stock deserves to be held forever, in a portfolio. But the market certainly has proven time and time again that if you're willing to ride it out for a decade or more, the odds tilt significantly in your favor for turning a profit. I think that I've seen statistics that say in any rolling 20-year period, for example, you've never lost money. So I think that you have to have that kind of a long, calm view and spend less time maybe listening to the talking heads on TV who are shouting and pressing buttons and making all sorts of crazy noises, other than obviously on Halloween. We're allowed to do that, right?
No name shall be given there, Todd.
No.
But yeah, we'll dive into more of really how to frame your mind in a cycle such as the one that we're in when it comes to your portfolio. But first, before we even dig into that, Todd, we're actually going to transition. We've been talking about the market, but let's actually dig into some of the scariest healthcare stocks that we've seen so far this year. Shifting gears, let's talk about some spooky stocks. Of course, as many of our listeners can attest, in the healthcare space, there's never a shortage of spooky, scary stocks to follow along with. And certainly this year has not been an exception to that rule. There are plenty of management mishaps, some commercialization woes, pipeline blowups. We've actually chosen what we've considered to be the top 3 spookiest stocks of this year. So I want to start off with the first one. This is the one I actually like to call the zombie stock, if you will. And that company is called Geron Corporation. That ticker symbol is GERN. Todd, this company has been around for almost 30 years, believe it or not. And it's really been hoping to kind of drag its lifeless zombie body across the finish line, getting from, small biotech to commercially profitable biotech. And it has really been limping its way to that. I was looking today just at the stock. It had its heyday really back in the early 2000s when at one point the stock was actually trading over $60 a share. Today, that share price is $1.53, believe it or not. Todd, I'm starting to think that maybe this might be the end of the road for Geron. What do you think?
It does not look good. It does not look good. I mean, this is a super scary stock. It's got to be, one of the most frustrating stocks for investors who had a lot of high hopes that imetelstat, their drug for myelofibrosis, myeloblastic syndromes, would pan out. Unfortunately, they were developing that drug with Johnson & Johnson. Johnson & Johnson had an opt-out clause in their license agreement that would allow them to give their rights back to Geron if they didn't like what they saw in the phase 2 data. And sure enough, that's what happened. J&J crunched the numbers, looked at the developing landscape, competitive landscape, and the indications, and decided, yep, we're not willing to hand over all of these hundreds of millions of dollars in milestones, pay for all of these development costs to be able to get this imetelstat across the finish line. And now that leaves Geron in a really tight spot, because they need to figure out, okay, we just lost our licensing partner. We don't have a ton of cash on the books, and now we're going to have to conduct these expensive phase 3 trials on our own. How the heck are we going to do that? And I think that's obviously the big reason why this has been one of the worst stock performers this year. And sadly, Shannon, I don't think there's a lot of hope left for a reawakening of this stock, at least until 2020, when maybe if they can find the cash somewhere to keep going, they might have some additional data they can share with us that gets investors excited.
Yeah, and what's so disappointing about the stock is there was tremendous optimism heading into many of these trials in myelofibrosis that you mentioned, the early data really seemed to suggest that the drug could actually reverse the effects of myelofibrosis, which is basically a type of cancer that turns the bone marrow into scar tissue. And so there was a lot of optimism with that. And it certainly would have given Geron's imetelstat drug a leg up commercially when you compare it to Incyte's Jakafi, because Jakafi does not do that, and JAK inhibitors don't do that. So this could have been really interesting play, could have easily been a front runner in that space. And even on the other indication, MDS, myelodysplastic syndrome, and that's a cancer-like disease of the bone marrow. The results were also encouraging there initially. Patients treated with the drug at one point actually became blood transfusion free. They didn't have to continuously go for blood transfusions. But over time, you actually started to see these patients relapse. So that meant basically the treatment didn't have that durable effect that they were hoping there. So on both fronts, very disappointing. Of course, we know for MDS, they are going to proceed with phase 3. Lot of hope lost, though, I think, for myelofibrosis. So a lot of big question marks there. But there were a lot of, I guess, red flags along the way, too, Todd.
Yeah, creaky doors, dark hallways, voices telling you maybe you should leave the building. Why are you going into this dark room? Why are you going? And I think that, if we can take away any lessons that we can apply to our future investments in biotech, it would be that, always be a little bit cautious when you've got, for lack of a better term, a one-trick pony, one drug in development. Obviously, 90% of clinical trials fail. The odds are set against you. I would also say that another one of the warning signs to learn from was the fact that J&J had to discard early on a low-dose version of imetelstat, or one of their cohorts, low-dose cohorts, because of a lack of efficacy. Maybe that was hinting that there could be some problems beyond that. So, and then the last, I guess, warning sign might have been the fact that J&J really didn't risk a lot to license this drug. They only paid $35 million up front. It was all back-end loaded with milestones after they would have agreed to take this thing into phase 3. So, maybe avoid small upfront back-end loaded deals.
Yeah, very important lessons there. And even, too, there was, I guess, some writing on the wall when you saw the company raise about $84 million in the second quarter of this year. And a lot of investors were already beginning to suspect that J&J wasn't going to move forward because the company Geron was actually set to receive, I believe it was $65 million in a milestone payment. And of course, all of that was dependent on whether or not they would proceed. And so I think the writing was on the wall when you saw the company do that financing round earlier this year as well. But I think, the take-home message, it's certainly troubling, frightening for Geron investors, but even more so for the patients. Because, Todd, as you know, Jakafi is really, it's really the lone winner out there, but it does not work for everyone, and it doesn't work all that well for very long.
75% discontinuation rate to a Jakafi within 5 years, Shannon. Obviously a major and important need for new drug therapies. And, Geron, obviously the derailing there of its drug is bad news and disappointing for patients who are eager to find, new options.
Exactly. So I think the company ended with about $183 million in cash on its books. It's obviously going to need to either find a new partner, get some money, or continue to try to raise funds. I think it's going to be really hard based on where they're at and what the data is showing currently. But certainly something to keep your eye on if Geron can continue for maybe another next 30 years. I don't think so, but certainly something to watch. So our next stock, Todd, this is a stock called Synergy Pharmaceuticals. This is ticker symbol SGYP. This is a biopharma stock that has had its eyes set on the very highly lucrative and very competitive gastrointestinal space. And it has its lead drug, Trulance, that was actually approved in 2 GI indications going back to early 2017. They got approved for their second indication earlier this year. I took a look at this stock. Right now, the stock is sitting at about, believe it or not, 39 cents a share. That's down 85% on the year. And really, Todd, this stock is another classic example of where marketing approval is really only the beginning. Commercialization is a much larger, much bigger beast that's much tougher to conquer.
Absolutely. Clinical stage stocks, they'll rally up, they'll rally down, they'll trade a lot on excitement and peak sales forecasts and all that stuff. Then when it gets to rubber meets the road, and you actually have to prove that out by winning over payers and getting in front of doctors. It's a very different ball game. A lot of companies struggle to do it, and that's why they go out and they get licensing partners. You know, Trulance competes against Ironwood's Linzess, and Linzess is paired up, or Ironwood's paired up on that drug with Allergan, which is of course a huge company with plenty of deep pockets that can market the drug and get it in front of people, and swing a big stick when it's talking to different payers to get formulary coverage that is better than what Synergy could do with Trulance. And Shannon, the scary thing here for investors really is the disclosure recently that Synergy's having a very difficult time in refinancing its debt, and that has increase the risk that this company's operating expenses are just so high that it's going to burn through the remaining cash that it has. If it can't renegotiate, then it could be called into default because currently it doesn't meet the covenants on the debt that it owes. And of course, that would be bad news for shareholders and obviously the employees of the company, and for patients, because they'd lose potentially access to what could very well be a fine drug that would work very well for them.
Yeah. And so I think between the go-it-alone strategy, I know back in, I believe it was 2015, the company was attempting to find a partner, potentially even a buyer. And according to the company, there weren't any offers that they thought really met the value of what Trulance was offering and for the value of the company. So there was no buyer, no partnership. You mentioned too the other issue, and that's related to these loan agreements. You've got sales and liquidity covenants that the company is currently not meeting, which puts it in a particularly dire place. There was the business update that they provided recently, and honestly, that was probably one of the saddest, most depressing business updates I think I've ever read, because ultimately it came down to we are very close and on the verge of bankruptcy is what I got from that. And so another thing I want to go back to is that you mentioned with Linzess and Ironwood and Allergan, this is a very competitive space, and you've got very deep-pocketed competitors who have a very strong commercial sales force, and now you're attempting to come onto the market alone. You don't have a deep-pocketed partner that can really help offset some of these costs and really get you across the finish line. And so what you see happening with Synergy is, I think, a classic tale of, for these small biotechs, you've got to have a big partner, especially in competitive spaces like GI.
Yeah. And, again, to lessons learned or the warning signs, what were those creaking doors? What were those voices saying to us that maybe would have helped us to avoid investing in Synergy? I think the things to bear in mind are, rapid cash burn, how quickly are operating expenses and R&D drawing down the cash that you have on your balance sheet? How often are these companies going out and having to tap investors for dilutive equity? And then if they're not able to do that, do they owe money through loans to other third parties that aren't your traditional banks that are providing liquidity? Do they have, are they converts? Are they preferreds? Do they have, interest rates that are, in case of Synergy, 9.5%? Obviously, lenders were not very willing to front up at favorable rates money to this company. So maybe that's a warning sign. So just pay attention, listeners, to how much debt companies have on the balance sheet, how much cash they have, how quickly they're going through that cash, and where they're getting the funding that they need to keep going.
Fair enough. And Todd, I'm going to throw out another warning sign. You tell me if you think this is a warning sign. But this was actually the company that was behind the infamous poop troop. And excuse my language, I'm not making that up. This is literally the, I guess, marketing ploy the company went after in 2017, where they created this pack of, I guess, emojis really designed to increase the conversations around constipation. Weirdest, strangest thing I think I've ever seen, Todd. Was that a warning sign in your eyes?
Could be. I mean, someone took a swing and unfortunately a miss in the marketing department on that one.
That is for sure. And certainly not enough to keep this stock out of the toilet. Yes, I did go there. All right, let's turn our attention to our third and final stock. Todd, this one for me, there was so much riding on this stock. The company is Incyte, ticker symbol INCY. And really, it's not so much the stock that's scary. It's what happened earlier this year with a drug that literally every investor had been watching, especially those that have been following the cancer immunotherapy space. So they had their lead drug, ipacadostat, and essentially what they were attempting to do is to see if they could take this drug and combine it with big players like Merck's Keytruda or Bristol Myers Squibb and Opdivo, and combine these drugs to really kind of have the combination effect of added efficacy by joining these drugs together. But what we saw, though, in the trials was that wasn't exactly the case. And things just started to fall apart. Todd, what can you tell us about that?
Yeah, I think, Shannon, the IDO inhibitor should have been called inhibitors.
Fair enough.
There was a ton of excitement leading up to the trial results that came out earlier this year. The IDO inhibition could be done alongside of some of these other immuno checkpoint therapies that had been so successful in oncology. And, that's the PD-1s and the PD-L1s that we've talked about in the show in the past, and matching these two up with slightly different mechanisms of action to be able to really allow the immune system to go out, find these cancer cells and destroy them. And, there was some early data that looked really, really encouraging. As a matter of fact, it was so encouraging, Shannon, that Incyte basically, jumped the shark. They, they went out and they started up a ton of late-stage trials combining their drug with Keytruda, which is Merck's PD-1, to see whether or not, they could reshape how we treat various cancers. I think they went into the bad news with, I want to say, I had it written down earlier, I think it was 8 or something like that, different late-stage registration-ready studies, and exiting the trial where it came up short and it just didn't work. It didn't work in melanoma, metastatic melanoma. They ended up having to ratchet back that program almost entirely. I think they still have a couple lung cancer trials that are going on in combination with Keytruda, but they even downgraded those from registration studies to phase 2 mid-stage studies. So, just really bad news all around for patients and investors who are excited about the IDO space, and shockwaves too, Shannon, that cut across to different companies. I mean, Bristol Myers abandoned their IDO program after the news was reported. And there was another company, Newlink, who's working IDO inhibitors. They're trading at like $2 a share now. At one point, they were a $50 stock.
Yeah, and it was I think 18 IDO combo trials going on at the time. And really, Incyte's IDO inhibitor was the furthest along. So the read-through to the industry was just tremendous. And there was so much hope going into the space. Matter of fact, ipacadostat was at one point number 3 on Evaluate Pharma's top 10 list of 2018 launches, with projected close to $2 billion in peak sales. So there was a lot riding on this. With that being said, though, of the 3 stocks, I think Incyte was probably best prepared to have these setbacks. As you know, being a biopharma investor, no matter how encouraging early stage data looks, oftentimes when you get to these bigger trials, things just don't work out. But really, I think Incyte has thankfully approved products that are blockbusters and can actually lessen the blow of what happened with this drug.
I think out of all these 3 drugs, companies that we just talked about, this one's most likely best positioned to bounce back. and regain some of that ground. I mean, it does have a pipeline. It does have products on the market right now, including the blockbuster Jakafi. So, I mean, it can withstand that hit. It's disappointing, though. And obviously, having your shares cut in half in the span of a few months is never something that investors want to see. So we'll have to see where we go from here with this company. There's some competition coming from Celgene and Fedratinib potentially as soon as late next year. So we're going to want to keep an eye on that as well.
Yeah, for sure. So turning our attention, we've talked about the market, we've talked about certain stocks that we've been watching, but really in terms of the average everyday investor, when it comes to protecting yourself, preparing for not only bad news, but also to just corrections within the market. Todd, what are, I guess, some general words of wisdom when it comes to portfolio?
Ignore a lot of what you hear. I have to say it. I mean, okay, so just back up a little bit. So we saw this nearly 10% decline in the market this month. And, over the course of a month, if I lose 1% here, or if I lose 1% here, it's not so horrible feeling. But we had 2 separate days this past month where the S&P 500 fell more than 3% in the trading session. And I guarantee you that we have listeners out there who saw their accounts fall by multiples of that because some of these stocks were falling 5 or 10% on those days. And that is hard. It is hard as an investor to watch and see that and not want to do something, right, Shannon? We are hardwired to avoid danger. Doesn't matter if that danger is a ghoul coming up behind us that we can't see, the creepy music, sounding, or if it's coming in a falling account balance. And I think that we need to kind of fight back, and the way we can fight back against those emotions and those reactions is to be very proactive, to recognize that, 3% declines, it's bad, but they're not uncommon. They happen. And, most of the time, the stock market is actually trading higher. So if you had gone out 30 days later, so if you had gone out and bought the 3% dip, you would oftentimes come out ahead within 30 days. Now, if you look at the last, just since 2000, right, you've seen the S&P 500 drop at least 3%, 66 times, 66 single-day drops of 3% or more. And, undeniably, each one of those felt absolutely horrible, right, Shannon?
It was painful, to say the least. And I think, too, one thing I want to bring out is, especially if you're a healthcare investor, it's important to diversify. That helps at least lessen the pain and the blow long term. I will say, too, though, that even if the market were to go into true correction territory, and also, too, thinking about it from a recession, even, if you will, the healthcare industry is one of those sectors that generally, I don't really like the term recession proof. I don't really think anything is. But in terms of performance, if you think about it, when it comes to medications, when it comes to surgeries even, this is one of the sectors where people will tend to continue to spend money on. You need your medications. If you're sick, you need to go to the doctor. And if you're really sick, you may have to have surgery. So there are definitely some, I guess, what I would call defensive plays that you can go after. There's stocks like, Johnson & Johnson, a huge dividend aristocrat stock that's got a very diversified revenue base, as the consumers, has a quite impressive immuno-oncology branch to it as well. Another one, too, Intuitive Surgical. That is probably one of the fools, one of our top stocks here. But with Intuitive Surgical, they're all focused on robotic surgery and really led the way with robotic surgery. And so there are a number of different ways that I think you can start to even just diversify the risk across the healthcare space. And really, even more so, your portfolio shouldn't just be made of all healthcare stocks either.
Right. Diversify. See, I said it. I'm going to try and go an episode where I don't, but I said it again. I would also add to that list, Shannon, that, try to restrict, don't use margin. Yes. Margin cuts both ways. And, we saw plenty of people, I'm sure, last month who ended up getting forced out of stocks because of margin calls and forced selling by their brokers. Just don't do margin. Diversify. Don't use margin. Keep a little bit of dry powder, a little bit of cash on the sidelines. It doesn't have to be a lot, even if it's only 5% of the portfolio. That will allow you to take advantage of these drops. So when a name like Intuitive Surgical goes on sale, or Illumina, or some of these other great companies that we talk about on the show, when those go on sale, you're able to step in and at least deploy some of those money on those 3% down days. And just to go back to that one more time, to hammer this point home, there have been 18 one-day drops of at least 3% just since 2010. And 12 of the 16 leading up to the 2 that happened this month, 12 of the 16, the market was higher 30 days later. So don't react in the moment to those down 3% days. Have a watch list, have some top stocks ready, and a little cash on the side to be able to buy them and take advantage of it as an opportunity.
Awesome. As always, wise words from Todd Campbell himself. I want to thank all of our listeners for tuning in. Of course, that's it for this week's show, but certainly check us out next week. In the meantime, be sure to check out Todd Campbell's costume on Twitter, please. It's awesome. He goes all out. But as always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. This show is produced by Steve Broido. For Todd Campbell, I'm Shannon Jones. Thanks for listening, and Fool on.